Gold just ripped higher while real yields refused to play along. And that's the kind of impossible tape that usually precedes a much bigger repricing. Not because the world suddenly discovered a new love for shiny rocks, because something is quietly changing in the hierarchy of what markets treat as safe. And you can see it in the plumbing if you know where to look. And later in this video, I'm going to give you the handful of price levels that matter, the two scenarios for the next 1 to 2 weeks, and the one detail that tells you whether this is a controlled rotation or the start of a forced move. For years, the clean story was simple. Real yields up, gold down, opportunity cost, basic, almost boring. When inflation-adjusted rates rise, you'd expect the non-yielding asset to get punished, or at least capped. That old rule trained an entire generation of traders to fade gold's strength the moment real rates firmed. It created muscle memory, and muscle memory is exactly what gets people hurt when regimes shift. Because this week, and really this whole stretch right now, gold is trading like it doesn't care that the textbook wants it to care. And that's not a vibe, that's a signal. But it's only a signal if you understand what kind of buyer is driving it. Zoom in on the tape. We're not talking about a sleepy drift higher that you can dismiss as seasonality. We're talking about speed. We're talking about a push that took gold from the low 4,300s early in the month into the mid 4,600s in a hurry, the kind of move that forces everyone who was comfortably short volatility to suddenly remember what leverage feels like. And here's the part most people miss. It's not just the level, it's the behavior around the level. When price starts holding bids on dips, when it stops giving you the clean pullbacks, when it stays elevated even as rates don't cooperate, that's where the real pressure starts. Now let's talk about the conflict, because conflict is where markets actually live. The mainstream explanation always wants to pick one driver. It's inflation, it's war, it's the Fed, it's the dollar. That's headline thinking, and headline thinking gets you chopped up. What's happening in gold right now looks like a multi-factor rotation where the market is repricing a specific kind of risk that doesn't show up cleanly in a single number like CPI. It's the risk that the things you thought were neutral aren't neutral, and that's why the real yields relationship is wobbling. Here's the hidden detail that reframes the whole story. The market is starting to treat policy credibility and institutional trust like a tradable risk factor, not as an abstract political argument, as a premium, as a spread, as something that can be hedged. When that premium rises, gold becomes less of an inflation trade and more of a balance sheet insurance trade. And insurance buying doesn't behave like speculative buying. It's sticky. It's not price sensitive in the same way. It doesn't wait for the perfect entry. It cares about exposure, not elegance. And that's why the classic real yields up, gold down relationship can break in real time while everyone is still quoting the old playbook. But that's not the part that matters most. The part that matters is what this shift forces participants to do. Because markets are not a debate club. They are a clearinghouse for constraints. If gold is rising despite shouldn't conditions, somebody is absorbing supply with a mandate. Somebody is allocating with a fear function, not a momentum function. And if that's true, then the next move isn't about whether your favorite commentator is bullish. It's about whether the plumbing can handle the flow. So let's open the hood. Gold isn't one market. It's a network. You've got spot markets, you've got futures, you've got OTC flows, you've got ETFs, you've got physical bars moving through refining and vaulting systems, and you've got central banks and sovereign actors that don't announce a trade like a hedge fund does. When conditions are calm, those pieces line up, and the price you see looks like one coherent thing. When conditions get tense, the linkage starts to squeal. Basis can behave differently. Spreads can move. Availability and delivery preferences start to matter. Paper can run ahead of physical, or physical demand can quietly underpin paper weakness. And when you see gold acting stubborn against real yields, one of the first questions you should ask is, who's actually setting the marginal price right now? Because if the marginal price setter is a short-term speculator, real yields will bully them. They're rate sensitive. They can rotate into yield-bearing assets. If the marginal price setter is a sovereign allocator hedging credibility risk, real yields are just one input. They're not the decision. If the marginal price setter is an institution managing tail risk into a calendar window, they'll pay up for convexity, even if yields are high. And that's where the real move starts, because it changes the elasticity of demand. The market becomes less willing to sell. Now, quick and clean, what do real yields actually mean here? People throw the term around like it's a magic spell. In practice, when macro traders talk about real rates, they're often looking at inflation-protected yields, like the 10-year TIPS yield, as a proxy for the inflation-adjusted return you can lock in on government paper. When that real yield rises, the opportunity cost of holding gold typically rises. That relationship is real. It's not fake, but it's also not a law of physics. It's a tendency that holds most strongly when the market is primarily trading the inflation and rate story. When the story becomes system trust and reserve preference and policy credibility, the correlation can weaken. And correlation weakening is not random, it's information. And that's where the next detail flips the setup. Gold doesn't need real yields to fall if the dollar's role is being questioned at the margin. It doesn't need real yields to fall if the buyer isn't optimizing for yield. It doesn't need real yields to fall if the risk you're hedging is not inflation. It's the integrity of the regime itself. That can sound dramatic, but you don't have to be dramatic to see incentives. Institutions hedge what they can't control. Sovereigns diversify what they don't fully trust. Funds buy what performs in the stress regime they fear. And when those actions cluster, you get a price move that looks like a break in the rules. Now let's build the proof stack, because one argument is a story, not a thesis. You want layers. You want mechanisms that rhyme across different data types. And you want to know what to watch next. Proof point 1 is the tape itself, the speed and persistence of the move. Gold pushing and holding in the mid-4600s area after being in the low 4300s earlier in the month is not just a number. It's a stress test of sellers. If sellers were in control, you'd see sharp rejection at obvious levels, quick fades, and clean mean reversion. Instead, you're seeing a market that keeps getting bids, and that changes behavior. Shorts get less comfortable. Sellers get less aggressive. Dip buyers get bolder. That's reflexivity. Proof point 2 is participation. If a market goes vertical on thin volume, you can dismiss it as a squeeze that can fade. If it moves with heavy participation, it's more likely a genuine rotation. In futures markets like COMEX, what matters is not just volume, but open interest behavior and how price responds to liquidation. When price rises and participation holds, it suggests fresh demand is absorbing supply rather than price simply levitating on air. I'm not going to pretend we have perfect transparency on every player, but we don't need perfect transparency. We need the footprint. And the footprint of a stubborn bid matters. Proof point 3 is institutional flow behavior, especially the slow-moving kind. Central bank gold buying has been a major feature of the last few years, and when that bid is present, it acts like a floor under long-term demand. Even if the pace varies month to month, the structural preference matters. It means the marginal buyer class includes actors who are not trading a 2-week chart. They're managing reserves, confidence, and diversification. That turns gold into an asset with a different demand curve than the retail narrative implies, and that S, why it can keep going even when the macro tourist expects it to stop. Proof point 4 is cross-market behavior. If gold strength were purely about inflation fears, you'd expect certain correlations to tighten and others to loosen. If it's about haven rotation and credibility hedging, you often see stress patterns elsewhere. Currency volatility, risk premia shifting, funding conditions tightening, and the kind of sentiment that makes people pay for insurance. Even without naming every driver, you can watch whether the market is rewarding liquidity or punishing it. You can watch whether safe assets are behaving safely. And right now, gold is behaving like a hedge people actually want to hold. Proof point 5 is market structure around calendar windows. This is the one people always underestimate because it's not sexy, but it's real. Month end, quarter end, options expiry windows, delivery cycles. These are moments when flows stop being discretionary and start becoming mechanical. Funds rebalance, dealers adjust hedges, margin requirements ripple. Liquidity thins at the exact moment when everybody wants to transact. And when gold is already bid, those mechanical flows can turn a controlled move into a lurch. The calendar is the catalyst. And if you ignore the calendar, you keep getting surprised by random volatility that is not random. Now, before we go further, I want to make one thing crystal clear for credibility. Gold can whip around violently even if the thesis is correct. You can be right about the direction and still get emotionally chopped into dust by the path. That's how these markets punish ego. So we're going to separate trend signal from noise, and we're going to do it using structure, not vibes. Here's a simple way to hold the framework in your head. Gold's bullish pressure can come from 2 broad channels. Channel 1 is the rates and inflation channel. Real yields fall, the dollar weakens, inflation expectations change, and gold responds. Channel 2 is the credibility and insurance channel. The market pays up for an asset that is nobody's liability, and demand becomes less sensitive to real yields. What you're watching right now is Channel 2 flexing. And if Channel 2 is the driver, you should expect 2 things. 1, dips get bought faster than you think they should. 2, correlation breakdowns become common. That's the warning label. Now let us talk about the mechanism that can turbocharge this in the near term. Options and dealer hedging. This is where people's eyes glaze over, but I'm going to make it simple. Dealers who sell options often hedge their exposure by trading the underlying. When price moves, the options delta changes, and the hedge needs to be adjusted. In certain conditions, especially near big strike areas and near expiration, those hedging flows can become self-reinforcing. If price rises into a region where dealers are forced to buy more to stay hedged, their buying pushes price up further, which forces more buying. That's a reflexive loop. That's gamma dynamics. It doesn't create the long-term thesis, but it can absolutely shape the path over a week or two. And if you're trading or investing around this, the path matters, because the path is where emotions get weaponized, and that's where the market plays its favorite game. It uses volatility to extract bad decisions. You get a sharp pop, everyone feels FOMO. Then you get a savage pullback, everyone feels regret. Then you get a grind higher, everyone feels confused. Then you get a gap, and everyone feels betrayed. None of that changes the underlying pressure if the underlying pressure is structural. But it can make you behave like it did. And that's why most people don't lose money, because they were wrong. They lose money because they let the tape manipulate their time horizon. So here's your psychology shield, because you're going to need it if this rotation keeps running. First, stop thinking in terms of, I must buy the top or sell the bottom. Think in terms of exposure management. If you're bullish, the thesis, you want to avoid getting shaken out by noise. That means you need levels and invalidation, not feelings. Second, recognize the two most common emotional traps in gold rallies. The it-s too late trap and the it-was obviously manipulated trap. It's too late. Makes you freeze until it's even higher. It's manipulated, makes you dismiss the move until it's undeniable. Both traps serve the market, not you. Third, understand that violent pullbacks can be part of a bullish structure. If the market is repricing credibility risk, it doesn't move in a straight line. It moves in surges and resets. Your job is to distinguish a reset from a reversal. Now, back to the core question. Why is this happening right now? Why not 3 months ago? Why not next quarter? This is where the calendar and the macro plumbing connect. Right now, you've got a cocktail of catalysts: policy communication, sensitivity, risk-off positioning that can flip quickly, and the kind of month-end and options window mechanics that force re-hedging and rebalancing in a compressed time frame. Liquidity in many markets is thinner than people think. And when liquidity thins, price can move farther on the same flow. That's not mysterious. That's math. And this move isn't emotion. It's math. The other why now detail that matters is that markets are constantly trying to front-run each other. If institutions believe other institutions will diversify into gold, they move early. If funds believe month-end rebalancing will create a bid, they position ahead. If dealers see that their hedge needs will increase into expiration, they adjust early. You get a cluster. And clusters create breakouts. That's the setup. But the next detail is what flips the whole thing. What happens when it becomes crowded on the wrong side? Because if gold rises and stays elevated, it pressures two groups at once. It pressures the systematic sellers who treat gold as a mean reverting instrument against real yields, and it pressures the discretionary shorts who assumed they'd get a clean fade at obvious resistance. When those groups start covering, it's not a gentle process. Covering is buying. Buying is demand. Demand in a thin moment can become forced demand. And forced demand is how you get those air pocket moves. Where price doesn't trade through levels, it teleports. If you've ever watched a market gap, you know what I mean. The book isn't a smooth curve. It's a set of cliffs. Now, let's put structure on the chart without pretending we have divine precision. You don't need 10 indicators. You need 3 things: the breakout zone, the retest zone, and the invalidation zone. Right now, the mid-4,600s area is your battleground. It is the area that tells you whether the market is accepting higher prices or just spiking through them. Above that, you're watching for continuation behavior, higher highs that hold, not just wick. Below that, you're watching for a controlled pullback that finds support and stabilizes. The obvious psychological zone below is the $4,500 area, and below that, you're looking at prior congestion zones around the mid-4,400s. Those are not magic numbers. They're crowd numbers. They're where behavior changes. Here's how to think about it in 2 scenarios, because this is where you protect your credibility and your capital. Scenario 1 is the controlled pullback and retest. In this scenario, gold pulls back toward that $4,500-ish zone. Maybe it wicks lower, but it stabilizes. The selling looks like profit-taking, not panic. The bounce is not a single violent candle, but a series of higher lows. That would be the market digesting gains while keeping the underlying bid intact. If you see that, it's a sign the rotation is healthy. It means new buyers are willing to step in on weakness. It means the move is being absorbed. Scenario 2 is the continuation, squeeze, and gap risk. In this scenario, gold stays pinned high, liquidity remains thin, and any push above the recent highs triggers mechanical buying, covering hedging, momentum allocation, maybe even a wave of "I can't miss this" positioning. In that world, you can get sharp up days and nasty intraday whips. You can also get the kind of overnight gap that makes people swear the market is out to get them. This scenario is faster, it's more violent, it's more emotionally expensive. And it's where people get tricked into buying high, selling low, and then buying back higher. That's why you need your plan before the move, not during it. Now, what confirms the thesis this is a real rotation in the next 1 to 2 weeks? First, price acceptance above the battleground zone. Not just a spike, acceptance. That means closes that hold, dips that are shallow, and rebounds that are fast. Second, correlation behavior. If gold stays firm, even as real yields don't collapse, that's confirmation that the driver is not simply rates down. Third, participation footprints. If the move continues with healthy participation rather than dying on exhaustion, it suggests this is not just a one-day wonder. Fourth, cross-market stress cues. If the broader environment continues to reward hedges and punish complacency, gold's bid makes sense. Fifth, calendar follow-through. If you see heightened volatility into key windows, but the market refuses to give back the gains, it's telling you that forced flows are being absorbed by bigger hands. And what weakens or invalidates the thesis? This is where you stay honest. A sharp sustained surge in real yields, especially if it comes with a strengthening dollar and a repricing of growth, can pressure gold. A sudden liquidity shock can force indiscriminate selling because in a true scramble, people sell what they can, not what they want. A violent reversal below the key retest zones, where dips stop being bought and start being sold, would tell you the bid wasn't T-structural. And a regime shift back into a clean, risk-on, yields up, dollar up environment can cap gold even if the long-term story remains intact. Those are real risks. Ignore them, and you become a hype merchant. Respect them, and you stay solvent. Now, let's address the skeptics directly, because I know who's listening. There's a whole crowd that will say, this is all manipulation, or this is all a bubble, or this is just fear. Here's the grounded way to talk about institutional behavior without getting cartoonish. Markets are structured around incentives. Large participants hedge, dealers manage risk, funds chase tracking error, sovereigns diversify reserves. None of that requires a secret meeting. It requires constraints. The suppression story is usually a simplified attempt to explain why price doesn't typically do what someone emotionally wants it to do. But the real story, the useful story, is how market structure and incentives shape the path. And right now, incentives are aligned toward owning insurance. That said, the physical versus paper tension is still a real concept, and you should understand it. Futures markets are extraordinary tools for price discovery, but they are also leveraged. A lot of gold exposure is paper exposure. In calm times, paper and physical are tightly linked by arbitrage and trust. In stress times, that linkage can get noisy. Physical demand doesn't have to be shortage panic for it to matter. It can be quiet preference. It can be incremental. It can be driven by procurement norms and reserve policy. And when that preference rises, the paper market can feel it as a persistent bid, tighter offers, and a reluctance to sell into dips. You don't need to see empty shelves to know the demand curve changed. You need to see sellers disappear. Now, let's do a quick mental calculation, because pattern interrupts matter and it keeps you thinking clearly. If gold moved from roughly $4,300 to roughly $4,600, that's about $300. On a $4,300 base, that's around 7% in a couple weeks. In an asset, people call them slow. That's not slow, that's a warning flare. It means your risk management has to adjust. It means position size matters. It means stop placement matters if you're trading. It means time horizon clarity matters if you're investing. Because when a slow asset starts acting fast, the market is telling you the underlying driver is not casual. And here's the part people always underestimate. Volatility will be used against you. If institutions are rotating into gold, they don't want to hand you a clean entry. The market will whip. It will shake. It will create narratives on every dip. It will make you feel stupid for being early and stupid for being late. That's the psychological squeeze. And the way you avoid it is by deciding what you're actually doing. Are you trading the next 48 hours? Then you care about intraday liquidity and option flows. Are you watching the next 1 to 2 weeks? Then you care about acceptance levels and the calendar. Are you focused on the macro rotation? Then you care about the persistence of correlation breakdowns and the behavior of institutional flows. Time horizon first, emotion second, always. So what do you watch next, specifically this week and into the next 1 or 2? Watch whether gold can hold above the battleground zone in the mid-4600s area. Watch whether the first meaningful pullback gets bought near $4,500. Watch whether a deeper flush into the mid-4400s gets immediately rejected, or whether it opens the door to a more serious unwind. Watch how the market behaves around obvious highs. Does it stall and reverse, or does it consolidate and then lift? Consolidation near highs is strength. Violent rejection is caution. Watch the tone of the tape. Does bad news push gold up more than good news pushes it down? That asymmetry is telling you who's in control. And yes, watch real yields. Not because they are the only driver, but because a sudden spike can change the path. If real yields surge and gold refuses to drop, that's actually bullish in this framework. It means the rotation is overpowering the old rule. But if real yields surge and gold starts breaking key supports, that tells you the old rule is reasserting itself in the short term. Same data, different implications depending on price response. That's how pros think. Data is not truth, response is truth. Now, if you're someone who wants targets, here's the sober version. Targets are not promises, they're scenarios. If gold can accept above the recent highs and build value there, the next psychological magnet is the next round number zone above and then the next. Think in terms of magnets and air pockets, not precise predictions. If the squeeze scenario takes over, it can overshoot quickly because forced buying doesn't care about valuation in the moment, but overshoots also snap back violently. If the controlled retest scenario plays out, you might get cleaner structure, which is healthier for sustained trends. Both can happen. The market doesn't owe you one. And that brings us to the most important line in the whole video. If one level breaks, the math changes. If gold loses the retest zones and fails to recover quickly, you have to respect that. If it holds and rebuilds, you have to respect that too. Your job isn't to be right in an argument. Your job is to adapt to what the market is clearing at. Now, let's wrap this into a clean, near-term roadmap you can actually use without becoming a prisoner of every headline. Base case. Gold is in a safe haven rotation regime where credibility and insurance demand are supporting price even as real yields don't collapse. In that base case, you expect volatility, but you expect dips to be bought above key supports. You expect consolidation near highs. You expect the market to keep frustrating anyone waiting for a perfect pullback. Confirmation is acceptance above the battleground zone and resilient behavior on the first real test lower. Invalidation is sustained trade below the key supports with weak rebounds and a return of the old correlation. Yields up, gold down, dollar up. That's the scoreboard. Squeeze case. Mechanical flows accelerate into calendar windows, options, month end, liquidity thinness, and price moves faster than fundamentals can explain in a headline. In that squeeze case, you manage your emotions first. You don't chase every candle. You don't panic sell every dip. You respect gap risk. Confirmation is sharp continuation above highs with shallow pullbacks and fast rebounds. The warning sign is when continuation turns into exhaustion, huge spikes that immediately reverse and fail to reclaim. That's where blow-offs happen. And blow-offs can be profitable for some and destructive for most. Don't get cute. And finally, yes, remember, gold isn't just a trade, it's a mirror. When it behaves like this, it's reflecting stress in the system, sometimes visible, sometimes not yet visible. The point isn't to worship the metal. The point is to read the signal, understand the mechanism, and manage risk like an adult. If you're the kind of person who wants to track pressure instead of chasing narratives, stay with this community. Not because you need another bull cheerleader, because you need a framework that survives volatility. Next time you see a scary pullback, don't ask, is it over? Ask, did it break structure? Next time you see a rip higher, don't ask, is it too late? Ask, who is being forced to act? That shift in questions is the whole edge. Watch the battleground in the mid-42600s. Watch the $4,500 zone as the first real retest. Watch the mid-4400s as the line where healthy pullback can turn into regime doubt. Watch real yields, but judge them by the market's reaction, not by a textbook. And keep the calendar on your radar because forced flows don't announce themselves. They just show up in price and make everyone pretend it was obvious after the fact. Because the truth is simple. The old rule is bending, the buyer is changing, and the tape is telling you the market can't unsee it now.